In this video, I will explain you what actually happens when trading Bitcoin with leverage, how it works, and what risks there are to consider. What is leverage trading? When you register on a crypto exchange and buy Bitcoin, you are trading on the so-called spot market. You can buy or sell Bitcoin. If I have 1,000 euros and buy Bitcoin with them, the value of my money changes 1-to-1 as a percentage of the Bitcoin price from the time of the purchase. If the Bitcoin price rises 5%, the value of my invested capital also rises by 5%. And is then worth 1,050 euros. Leverage trading is different. For one thing, we usually do not trade Bitcoins directly, but so-called futures. Futures are contracts, which means that two parties agree to buy or sell a fixed amount of Bitcoins at a certain price on a certain date. For an end user, it makes no real difference as the prices of Bitcoin on the spot market and the Bitcoin contracts on the futures market are almost identical. With leverage trading, I'm now not just buying Bitcoin with my money, but I can also borrow money and trade with it. For example, I could deposit 1,000 euros and then buy Bitcoin with a 5x leverage. If the Bitcoin price now rises 5%, I don't make a profit of 5% and thus 50 euros, but 5% times 5 and thus 25% plus, which means that I would make a profit of 250 euros. How does leverage trading work? Bitcoin trading uses leverage so that profits and losses are amplified. For example, if we use a 5x leverage, our gains and losses will always be 5 times greater than if we were simply trading Bitcoin without any leverage. Leverage is achieved by borrowing money from the trading platform. If I deposit 1,000 euros and use a 5x leverage, I'm trading with a total of 5,000 euros. My 1,000 euros are deposited as a collateral to cover any losses, and with the 5x leverage, I now have access to 5 times the amount, for example, in this case, 5,000 euros, which I can trade with. You also have to pay fees on this borrowed money, which are automatically collected depending on how long you keep a position open. These are called funding fees. This amount depends on the position size and the current market conditions. So if more other traders are currently long or short. Other than that, there are the typical order fees that occur when opening and closing positions. With leverage trading, we can also now profit not only from rising prices, but also from falling prices. Let's take a look at a first example. We want to bet on rising prices and open a so-called long position with a 5x leverage. This means that we deposit our 1,000 euros as collateral and use the borrowed 5,000 euros to buy Bitcoin. The price is currently at 50,000 euros, which means we get 0.1 Bitcoin for our 5,000 euros. Now the price rises by 10% to 55,000 euros. The value of our 0.1 Bitcoin has therefore risen to 5,500 euros. Now we sell the 0.1 Bitcoin at this price and receive 5,500 euros in return. We have to give back the 5,000 euros as we only borrowed them, but the remaining 500 euros are our profit, which we can keep. Now we also get our 1,000 euros back, so we now have a total of 1,500 euros. This means that we have made a total profit of 500 euros on our original capital of 1,000 euros, which is an increase of 50% even though the price of Bitcoin has only risen by 10%. So here we can see the effect of a 5x leverage that has also increased our profits by 5 times. Let's now take a look at how you can bet on falling prices in leverage trading by opening a so-called short position. This means that we again deposit our 1,000 euros as collateral and use a 5x leverage, and this time instead of borrowing euros, we take the 5,000 euros in Bitcoin. Not euros, but this time we really borrow Bitcoin. At a price of 50,000 euros, this corresponds to 0.1 Bitcoin that we borrow. We received this 0.1 Bitcoin, and what do we do with it? We now sell it directly and receive 5,000 euros in return. The price of Bitcoin now falls by 10% to 45,000 euros. The price has therefore moved in our desired direction, and we now want to close our position again. This means that we have to buy back the 0.1 Bitcoin so that we can return them, because we originally only borrowed 0.1 Bitcoin. However, 0.1 Bitcoin now has become cheaper due to the lower price, and we only have to pay 4,500 euros for 0.1 Bitcoin at a price of 45,000 euros. So we buy the 0.1 Bitcoin for 4,500 euros and return it to the platform. The 500 euros that are still left is our profit, which we can keep. Now we also get our 1,000 euros of collateral back, and we can see that we now have a total of 1,500 euros, and we have made a profit of 500 euros on our original 1000 euros. This means that we have made a 50% profit on our capital, even though the price of Bitcoin has fallen 10%. What are the risks of leverage trading? Trading with leverage naturally always involves risks that you should always be aware of. It can of course happen that the price does not move in the desired direction, and just as profits are multiplied, losses are also multiplied. Let's say we take 1000 euros and bet on rising prices with a 5x leverage. If the price goes up by 10%, we make a profit of 500 euros and thus a gain of 50%. However, if the price falls by 10%, we make a loss of 500 euros and lose half of our initial amount. If we take this to an extreme and say we use a 100x leverage, we would double our money if the price only goes up by 1%, but if the price goes down by 1%, we would lose all of our invested capital. The question that is often asked is, can you lose more money that you have invested? Can I actually gamble away the money that I borrowed? This is not possible with the vast majority of platforms. All the platforms that I use and that you can also find on my channel, this is not possible, so you can only lose a maximum of the amount that you have put in by yourself. So you cannot get into any debt. If a position goes so far into the red that the collateral you have deposited can no longer cover the losses, the position is automatically closed by the platform. This happens at the so-called liquidation price. When you open a trade, this price is displayed, and this would be the price at which the position would be automatically closed, and you would lose your entire stake for this trade. However, you don't have to let it get that far and reach this liquidation price, but you can also protect yourself beforehand by setting a stop loss. A stop loss ensures that the position is closed beforehand at a certain loss so that you can limit your loss. For example, if I enter a position with my own 1000 euros, regardless of the leverage, I can say that I want to close the position automatically if I lose 50 euros. Now I cannot lose more than these 50 euros in this trade, and this allows me to limit my own risks. I hope this made the topic of Bitcoin trading a little easier to understand. If you are more interested on the topic, you're welcome to take a look at the video description where I have linked further tutorials and the best crypto trading platforms. If you have any other questions, always feel free to ask them in the comments.